It is time for CFA Level 1 Part 7. No. Level 1 Reading 7. Okay, so it is time for CFA Level 1 Program Curriculum Reading. Reading 7. Level 1 Reading 7. So discounted cash flow applications. So we learned about discounted cash flows, learned about cash flows, and let's learn about applications now. Learning outcomes. Candidates calculate and interpret the net present value, NPV, and the internal rate of return, IRR, of an investment. Contrast the NPV rule to the IRR rule, and identify problems associated with the IRR rule. Calculate and interpret a holding period return or total return. Calculate and compare the money weighing and time weighing rates of return of a portfolio, and evaluate the performance of portfolio based on these measures. Calculate and interpret the bank discount yield, holding period yield, effective annual yield, and money market yield for U.S. Treasury bills and other money market instruments. Convert among holding period yields, money market yields, effective annual yields, and bond equivalent yields. Okay, so yeah. Introduction. An investment analyst much to our work includes evaluating transactions involving present and future cash flows. In this reading on the time value of money, TVM, we presented the mathematics needed to solve these problems and illustrate the techniques for major problem types. In this reading, we turn to applications analysts must master for the numerous applications of TVM or discounted cash flows. Analysts in quantity, fixed income, and derivative analysis as they study each of these topics individually. In this reading, we present a selection of important TVM applications, net present value, and internal rate of returns as a tool for evaluating cash flow streams, portfolio return management, and calculation of money market yields. Important in themselves, these applications also introduce concepts that reappear in many other investment contexts. The reading is organized as follows. Section 2 introduces the key TVM concepts, net present value, and internal rates of return. Building on these concepts, Section 3 discusses a key topic in investment management, portfolio return measurements. Investment management often face the task of investing funds for the short term. To understand the choices available, they need to understand the calculations of money market yields. The reading thus concludes with a discussion of the topic in Section 4. Net present value and internal rate of return. And in applying discounted cash flow analysis in all fields of finance, we repeatedly encounter two concepts, net present value and internal rate of return. In the following section, we presented these keynote concepts. We could explore the concepts of a net present value and the internal rate of return in many contexts. Because their scope of application covers all areas of finance, capital budgeting, Capital budgeting, however, can serve as a representative starting point. Capital budgeting is important not only in corporate finance, but also in security analysis, because both equity and fixed income analysts must be able to assess how well managers are investing the assets of their companies. There are three chief areas of financial decision-making in most businesses. Capital budgeting is the allocation of funds to relatively long-range projects or investments. From the perspective of capital budgeting, a company is a portfolio of projects and investments. Capital structure is the choice of long-term financing for the investments of the company wanting to make. Working capital management is the management of the company's short-term assets, such as inventory, and short-term liabilities, such as money owed or to suppliers. 2.1 net present value and the net present value rule. Net present value, or NPV, describes a way to characterize the value of an investment, and the net present value rule is a method for choosing among alternative investments. The net present value of an investment is the present value of its cash inflows minus the present value of the cash outflows. The word net in net present value refers to subtracting the present value of the investment outflows or the costs from the present value of its inflows, which are the benefits, to arrive at the net benefit. The steps in computing NPR applying the NPR rule are as follows. 1. Identify all cash flows associated with the investments, all inflows and outflows. 2. Determine the appropriate discount rate or opportunity cost of R for the interest investment project. 3. Using the discount rate, find the present value of each cash flow. Inflows have a positive signs of increase, and NPV. Outflows have a negative signs and decrease NPV. Sum all present values. The sum of the present value of all cash flows, inflows, and outflows is the investment's net present value. Apply the NPV rule if the investment's NPV is positive, and if an investor should undertake it. If the NPV is negative, the investor should not undertake it. If an investor has two candidates for investment but can only invest in one, i.e. mutually exclusive projects, the investor should choose the candidate with the higher positive NPV. What is the meaning of the NPV rule in calculating the NPV of the investment proposal? We use the estimates of the opportunity cost of capital as the discount rate. Once again, NPV stands for net present value. Okay, so it is the net present value describes a way to characterize the value of an investment, and the net present value refers to the method of choosing among alternative investments. The NPV is an investment in its present value of its cash flow minus the present value of its cash flow. Okay, so that's the NPV. So just in case you guys forgot what NPV is. Okay, so right here. What is the meaning of NPV rule in calculating the NPV of an investment proposal? We use an estimate of the opportunity cost of capital as the discount rate. The opportunity cost of capital is the alternative return that investors forego in undergoing the investments. When NPV is positive, the investment adds value because it more than covers the opportunity cost of the capital needed to undertake it. So a company undertaking a positive NPV investment increases shareholders' wealth. An individual investor making a positive NPV investment increases personal wealth, but a negative NPV investment decreases wealth. When working problems using the NPV rule, it would be helpful to refer to the formula NPV, the net present value, equals sigma, time equals 0 to time equals n, the CFT. What does the CFT stand for? You're using so many abbreviations. I don't know these abbreviations. What's the CFT? Here we go. CFT is the expected net cash flow at time t. Okay, at the final time. Okay, so there we go. Much better now. It's helpful that they have these handy tools down here. So N is of course the investment projected life, and R is the discount rate or opportunity cost of capital. Okay, there we go. So yeah, use sigma and you plug these in. As always, we state the inputs on a compatible time basis. If cash flows are annual, N is the projects life in years, and R is the annual rate. For instance, suppose you are reviewing a proposal that requires an initial outlay of $2 million. So CF0, okay, CF at time 0, which is initial, is negative $2 million. You are expected that a proposal investment will generate a net positive cash flow of CF1, $500,000, CF2, 7,500,000, and CF3 1.35 million. At the end of the 3 years, using 10% as your discount rate, you calculate the NPV as follows. So this, so it's sigma. So you guys all add them together. So you add all of them together. What you get is 0.088655 million. Because NPV is 88,655 is positive, you accept the proposal under the NPV rule. Consider an example in which a research and development program is evaluated using the NPV rule. Example 1, evaluating your research and development program using the NPV rule. As an analyst covering the RAD Corporation, you are evaluating its research and development R&D programs for the current year. Management has announced that it intends to invest $1 million in research and development. Incremental net cash flows are forecasted to be $150,000 per year in perpetuity. RAD Corporation's opportunity cost of capital is 10%. State whether RAD's research and development program will benefit shareholders as judged by the NPV rule. And secondly, evaluate whether your answer to part 1 changes the RAD Corporation's opportunity cost of capital is 15% rather than 10%. So solution to 1. The constant net cash flow of $150,000, which we can denote as CF, with a bar on top, from a perpetuity. The present value of the perpetuity is CF divided by R, so we can calculate the project's NPV value as this. So it's period 0 plus perpetuity divided by R, which will give us this. With an opportunity cost of 10%, the present value of the program's cash flow is $1.5 million. The program's cost an immediate outflow of $1 million. Therefore, the net present value is $500,000. As NPV is positive, you conclude that RAD's corporation, our research and development program, will benefit shareholders. A solution to 2, with opportunity cost of capital of 15%, you computed the NPV as you did above. But this time using a 15% discount rate. So you see these two lines, it's all the same, except now you are using 0.15 instead of 0.10. With a higher opportunity cost of capital, the present value of the inflows is smaller than the program's NPV. Is smaller at 15%. The NPV exactly equals $0 at NPV equals 0. The program generates just enough cash flow to compensate shareholders for the opportunity cost of making the investment. When a company undertakes a 0 NPV project, the company becomes larger, but shareholders' wealth does not increase. 2.2, the internal rate of return and the internal rate of return rule. Financial managers often want a single number that represents the rate of return generated by an investment. The rate of return computation, often used in investment applications, including capital budgeting, is the internal rate of return, IRR. The internal rate of return is a second method for choosing among investment proposals. The internal rate of return is the discount rate that makes net present value equal to 0. It equates the present value of the investment costs or the outflows to the present value of the investment benefits, the inflows. The rate is internal because it depends only on the cash flows of the investments. No external data is needed. As a result, we can apply the IRR concepts to any investments that can be represented as a series of cash flows. In the study of bonds, we encounter IRR under a name of the yield of maturity. Later in this reading, we will explore IRR as the money weighing rate of return for portfolios. Before we continue, however, we must add a note of caution about interpreting IRR. Even if our cash flow projections are correct, we will realize a compound rate of return that is equal to IRR over the life of an investment only if we can reinvest all interim cash flows at exactly the IRR. Suppose the IRR for a project is 15%, but we consistently reinvest the cash generated by projects at a lower rate. In this case, we will realize a return that is less than 15%. The principle can work in our favor if we can reinvest at rates above 15%. To return to the definition of IRR, the mathematical terms we said the follows. So NPR, net present value, equals CFO, CF at 0. What's CF again? I keep forgetting. What is CF? The expected net cash flow. Okay, so the expected net cash flow at 0 plus the expected net cash flow at 1 divided by 1 plus the internal rate of return to the power of 1 using this. Okay. Again, the IRR in equation 2 must be compatible with the timing of the cash flows. If the cash flows are quarterly, we have a quarterly IRR in the equation 2. We can then state the IRR on an annual basis. For some simple projects, the cash flow at t equals 0, CF0, or captures the single capital outlay or initial investments. Cash flows after t equals 0 at the positive rate of return of the investment. In this case, we could say CF0. Negative investments, the negative sign indicates an outflow. Thus, we could rearrange equation 2 in a form that is helpful in those cases. Investments is equal to this. For most real-life problems, financial analysts use softwares, spreadsheets, or financial calculators to solve this equation for IRR. So you should familiarize yourself with such tools. The investment decision rule using IRR, the IRR rule, states the following: except projects or investments for which the IRR is greater than the opportunity cost of capital. The IRR rule uses the opportunity cost of capital as a hurdle rate, or the rate that a project's IRR must exceed for the project to be acceptable. Note that it has the opportunity cost of capital is equal to the IRR, then the NPV is equal to 0. Using the discount rate less than the IRR, we make the NPV positive. With these comments in mind, we work through 2 examples that involve the internal rate of return. Example 2, evaluating a research and development program using the IRR rule. In the previous RAD corporation examples, the initial outlay is $1 million and the program cash flows are $150,000 in perpetuity. Now you are interested in determining the program internal rate of return, addressing the following. Write the equations for determining the interest rates of return of this R&D program. Calculate the IRR. This is the solution. Example 2, example 3. Oh my gosh, you got so much reading still. Okay. I'll skip the example and just go to 2.3. 2.3, problems with the IRR rule. The IRR and NPV rule give the same accept or reject decision when projects are independent. That is, when the decisions to invest in one project does not affect the decision to undertake another. When a company cannot finance all projects it would like to undertake, that is when projects are mutually exclusive, it must rank the project from most profitable to least. However, ranking according to IRR and NPV may not be the same. The IRR and NPV rules ranks projects differently when the size or scale of the project differs. Measuring size by the investment needed to undertake the project or timing for the project's cash flow differs. When the IRR and NPV rule conflicts in ranking projects, we should take directions from the NPV rule. Why does this the performance of NPV of an investment presentation, the expected addition to the shareholders' wealth from an investment, and we take the maximization of shareholders' wealth to be the basic financial objective of a company. So the maximization of financial wealth for the shareholders. To illustrate the preference for the NPV rule, consider first the case projections that differs in size. Suppose the company has only 30,000 pounds available to invest. The company has 2 available periods. Investment described between A and B in table 2. Okay, so this is the difference. Project A requires an immediate investment of 10,000. The project will make a single cash payment of 15,000 at t equals 1. Because IRR is the discount rate that equates the present value of the future cash flow with the cost of the investment, the IRR equals 15%. The IRR rule ranks project A with the higher IRR first. The NPV rule, however, ranks project B with the higher NPV first. A conflict with the IRR rules rankings choosing projects A because it has higher IRR, which will not lead to the largest increase in shareholders' wealth. Investing in project A effectively leaves 20,000 euros, which is 30,000 euros minus A's cost, uninvested. Project A increases wealth by almost 4,000, but Project B increases wealth by almost 9,000. The difference between the two projects' scales creates an inconsistency in the rankings between the two rules. IRR and NPV can also rank projects of the same scale differently when the timing of the cash flow differs. We can illustrate this principle with projects A and D presented in Table 3. So this is Table 3. Okay, so the terms CF0, CF1, CF2, and CF3 represents the cash flows at time period 0, 1, 2, and 3. The IRR for project A is the same as it was in the previous example. The IRR for project D is found as follows. So negative 10,000 plus 21,200 divided by this equals 0. The IRR for project D is 28.5%, compared with 50% for project A. IRR and IRR rankings are not affected by any external interest rate or discount rate because a project's cash flow alone determines the internal rate of return. The IRR calculation furthermore assumes the reinvestments at the IRR. So we generally cannot interpret them as achievable rates of returns. For project D, for example, to achieve a 28.5% return, we would need to earn 28.5% on $10,000 for the first year, earn 28.5% on $10,000 on the second year, and earn 25.5% on that much on the third year. A reinvestment such as the 50% or 28.5% may be quite unrealistic. By contrast, the calculation of NPV uses an external market determined discount rate, and reinvestment is assumed to take place at higher discount rates. NPV rankings can depend on external discount rate chosen. Here, Project D has a larger but more distinct cash flow of 21,220 versus 15,000. As a result, Project D has a higher NPV than Project A has a lower discount rate. The NPV rule assumptions about reinvestment rates is more realistic about the economically relevant because it incorporates the market-determined opportunity cost of capital as a discount rate. As a consequence, the NPV is the expected addition to shareholders' wealth from an investment. In summary, we are dealing with mutually exclusive projects. Choose among them using the NPV rule when using the IRR rule, and the NPV rule conflicts. Okay, so what is this reading about? NPV, IRR, lots of terminology. What is it about? Okay, so it's about choosing investments that will benefit the firm most. Okay. And in the last section, we talked about conflicts between NPV and IRR, which NPV may say that investment A is better, but IRR may say investment B is better. Now, what do we choose? We choose the one that makes more sense, right? So, yeah. So this is, and it talks about calculations of NPV. It talks about calculations of IRR, internal, yeah. So that's what, this is about. So we're continue reading part 3 in our next section of reading. So I hope to see you guys there. Goodbye. Okay. CFA Level 1, Reading 7, Part 3. CFA Level 1, Reading 7, Part 3, Portfolio Return Measurements. Suppose you are an investor and you want to assess the success of your investments. You face two related but distinct tasks. The first is performance measurement, which involves calculating returns in a logical and consistent manner. Accurate performance measurement provides the basis for your second task, performance appraisal. Performance measurement is thus of great importance for all investors and investment managers because it is the foundation for all future analysis. In our discussion of portfolio return measurements, we will use the fundamental concept of holding period return, or HPR, the return that an investor earns over a specific holding period for an investment that makes one cash payment at the end of one holding period, or HPR, is equal to P1 minus P0 plus D1 divided by P0, where P0 is the initial investment, P1 is the price received at the end of the holding period, D1 is the cash paid by the investment at the end of the holding period. Particularly when we measure performance over many periods, or when the portfolio is subject to additions or withdrawals. Portfolio performance measurement is a challenging task. Two of the measurement tools available are the money weighing rate of return measure and the time weighing rate of return measure. Yes. The first measure we discussed, the money weighing rate of return, implements a concept we have already covered in the context of capital budgeting, interest rate of return. So 3.1, money weighing rate of return, the first performance measurement concept that we will discuss in an initial rate of return calculation. The investment management application, the internal rate of return is called the money weighing rate of return because it accounts for the timing and amount of cash flow into and out of the portfolio. Illustrate the money weighing return. Consider an investment that covers a 2-year horizon. At time 0, an investor buys one share at $200 at time equals 1. He purchases an additional share at $225,000 or $225. At the end of year 2, T equals 2. He sells both shares at $235. So cash flows, when time is 0, outlay this much, time proceedings, and this much. The money weighing returns on the portfolio is its internal rate of return for the 2-year period. The portfolio's internal rate of return is the rate R, for which the present value of the cash flows, the cash inflows minus the present value of the cash outflows equals 0. Or PV equals outflow equals PV equals inflow. PV outflow equals PV inflow. Wait, this doesn't make sense. Okay, I'm so confused right now. These few chapters have been messing with me a lot. Okay, so the left-hand side of this equation details the outflow, 200 at time equals 0, and 220 at time equals 1. The 225 outflow is discounted back to one period before it occurs at t equals 1. The right-hand side of the equation shows the present value of the inflows, $5 at time equals 1, discounted back one period, and $480, the $10 dividend plus the $470 sales proceeds at time equals 2, discounted back 2 periods. To solve for the money weighing return, we use either a financial calculator that allows us to enter cash flows or a spreadsheet with the IRR function. The first step is to group the net cash flows by time. For this example, we have negative 200 for t equals 0, net cash flow negative 220 equals 205 plus 5 for t equals 1 net cash flow, and 480 for the t equals 2 net cash flow. After entering these cash flows, we use the spreadsheet or calculator's IRR function to find that the money weighing rate of return is 9.39%. If we take a closer look at what has happened to the portfolio during each of the 2 years, in the first year, the portfolio generated one period holding return of 5 plus 225 minus 200 divided by 200, which is 15%. At the beginning of the stock, the second year, the amount invested is 450, calculated as 225 per share price of stock multiplied by 2. Because of the $5 dividend was spent rather than reinvested at the end of the second year, the proceeds from the liquidation of the portfolio are $470, as detailed in Table 4, plus $10 in dividend, see also in Table 4. So in the second year, the portfolio produced a holding period return of 10 plus 470 minus 450 divided by 450, which is 6.67%. This means holding period return was 15 plus 6.67 divided by 2, which is 10.84%. The money weighing rate of return, which was calculated as 9.39%, puts a greater weight on the second year's relatively poor performance of 6.67% than the first year's relatively good performance of 15%. As more money was reinvested in the second year than in the first, that is the sense in which returns in the month are calculating performance are money weighted. As a tool for evaluating investment managers, the money weighing rate of return has a serious drawback. Generally, the investment manager's clients determines when money is given to the investment manager and how much money is given. As we have seen, these decisions may significantly influence the investment manager's money weighing rate of return. A general principle of evaluation, however, is that a person or entity should be judged only on the basis of their own actions or actions under their control. An evaluation tool should not isolate the effects of investment managers' actions. The next section presents a tool that is effective in that respect. Time weighing rate of return. So the first one, we had money weighing rate of return, and the second one, we have time weighing rate of return. An investment measure that is not sensitive to the additions of withdrawal of funds is the time-weighted rate of return. So the time-weighted return is different in the money-weighted return, because the time-weighted return is not sensitive to additions and withdrawals to funds. In an investment management industry, the time-weighted return is the preferred performance measure. The time-weighted rate of return measures the compounded rate of $1 initially invested in the portfolio over a stated measurement period. In contrast to the money-weighted rate of return, the time-weighted rate of return is not affected by cash withdrawals or additions to the portfolio. The term time-weighted refers to the fact that the returns are averaged over time to compute an exact time weighing rate of return on a portfolio. Take the following 3 steps. 1. Price the portfolio immediately prior any significant additions or withdrawals to the fund. Break the overall evaluation period into sub-periods based on the dates of the cash inflows and outflows. 2. Calculate the holding period return of the portfolio for each sub-period. 3. Link or compound holding period returns to obtain an annual rate of return for the year. The time weighing rate of return for the year. If the investment is for more than 1 year, take the geometric mean of the annual return to obtain the time weighing rate of return over the measurement period. Let us return to our money weighing example and calculate the time weighing rate of return for the investor's portfolio. In that example, we compute the holding period return on the portfolio. Step 2 in the procedures for finding time weighing rate of return, given that a portfolio earned an interest of 15% during the first year and 6.67% during the second year. What is the portfolio's time weighing rate of return over an evaluated period of 2 years? We find the time weighing rate of return by taking the geometric mean of the two holding periods. Step 2 in the procedures above, the calculation of the geometric means exactly mirrors the calculation of compound growth rates. Here, we take the product of 1 plus the holding period returns for each period to find a terminal value at t equals 2 of investment of $1 invested at t equals 0. We take the square root of this product and subtract 1 to get the geometric mean. We interpret the result as the annual compound growth rate
of $1 invested in the portfolio at t equals 0. Thus, we have 1 plus the time-weighted rate of return is equal to these two multiplied together. So the time-weighted return, if we move the square root to the other side, will give us 10.76%. The time-weighted rate of return of the portfolio was 10.76%, compounded with the money-weighing return of 9.39%, which gave larger weight to the second year's return. We can see why investment managers find time-weighting returns more meaningful for a client, if a client gives an investment manager more funds to invest at an unfavorable time. The manager's money-weighing rate of return will tend to be depressed if a client adds funds at favorable times. The money-weighing return will tend to be elevated. Time-weighing rates of returns remove these effects. In defining the steps to calculate an exact time-weighing rate of return, we said that the portfolio should be valued immediately prior any significant addition or withdrawals of funds. With the amount of cash flows actively in many portfolios, this task can be costly. We can often obtain a reasonable approximation of time-weighted rates of return by valuing the portfolio at frequent regular intervals, particularly if additions and withdrawals are unrelated to market movements. The more frequent the valuation, the more accurate the approximation. Daily valuation is commonplace. Suppose that a portfolio is valued daily over the course of a year. To compute the time-weighted rate of return, we first compute each day's holding period return, which is this, where MVBT equals the market time at beginning of day T, and NVET equals the market value at end of day T. We compute 365 such daily returns denoted as R1, R2, R365. We obtain the annual return for the year by linking the daily holding period returns in the following ways. 1 plus R1 multiplied by 1 plus R2 multiplied by 1 plus R3, all the way to 1 plus R 365 minus 1. If withdrawals and additions of the portfolios happen only at day's end, the annual return is a precise time-weighing rate of return for the year. Otherwise, it is an approximate time-weighing return for the year. If we have a number of data, we can calculate a time-weighted return for each year individually. As above, if Ri is time-weighted return for year I, we calculate the annualized time-weighted return as a geometric means of n annually returns as follows, which is this. Example 4 illustrates the calculation of time-weighted rates of returns. Example 4, the time-weighted rate of return. Stubeck Corporation sponsors a pension plan for its employees. It manages parts of the equity portfolio in-house and delegates measurements of the balance to super trust companies. As Chief Investment Officer of Stubeck, sounds like stupid. You want to review the performance of the in-house and super trust portfolios over the last 4 quarters. You have arranged for outflows and inflows to the portfolio to be made at the very beginning of the quarter. Table 5 summarizes the inflows and outflows as well as the 2 portfolios' valuation. In the table, the ending value is the portfolio's value just prior to the cash inflow or outflow at the beginning of the quarter. The amount invested in is the amount each portfolio manager is responsible for investing. So the beginning value increases. The beginning period inflow decreases. Amount invested increases because the value increases. Ending value decreases. Beginning value increases and decreases and stuff. So ending value decreases. Based on the information given, address the following. 1. Calculate time-weighted rates of returns out of an in-house account. 2. Calculate the time-weighted rate return of the super trust account. Okay, so solutions to 1. To calculate the time-weighted rate of return for in-house account, we compute the quarterly holding period returns for the account and link them into an annual return. The in-house account's time-weighted rate of return is 27%, calculated as follows. So this. Some difficult calculations, some annoying calculations. And Chinese will say 这个运算非常的麻烦. And it's really annoying. Okay, so we'll calculate it, we'll get 27%. Solution 2, the account managed by Super Trust has a time-weighted rate of return of 26%, calculated as follows. So when we use time-weighted rate of returns, we get 26%. If we calculate the in-house time-weighted return, then we get 27%. Okay. Example 5, time-weighted and money-weighted rates of return side by side. Your task is to compute the investment performance of the Wellbright Fund during 2014. The facts are as follows. On 1st of January 2014, the Wellbright Fund had a market value of 100 million. During the period 1st of January 2014 to 30th of April 2014, so the stock in the fund showed a capital gain of $10 million, so a 10% increase. On 1st of May 2014, the stock fund totaled dividends of $2 million, so 2%. All dividends were reinvested into additional shares. Because the fund's performance has been exceptional, institutions invested an additional $20 million in Wellbright on 1st of May 2014, raising assets under management to 132 million, which is 100 plus 10 plus 2 plus 20. What? No. Oh, yeah. 100 plus 10 plus 2 plus 20 is 132. On 31st of December 2014, that's a long time ago. That's 6 years ago. Man, so weird to think we're in 2020. Soon to be 2021. Damn, time flies. Okay. Wellbright received total dividends of 2.64 million. The fund's market value of 31st of December of 2014, not including the 2.64 million, is in dividends, with 140 million. Was 140 million. The fund made no other interim cash payments during 2014. Based on the information given, adjust the following. 1, compute the Wellbright Fund's time-weighted rate of return. 2, compute the Wellbright Fund's money-weighted rate of return. 3, interpret the difference between the time-weighted and money-weighted rate of return. Solution to 1. Because interim cash flows were made on 1st of May 2014, we must compute 2 interim total returns and then link them to obtain the annual return. Table 6 lists the relevant market value on 1st of January, 1st of May, 31st of December, as well as associated interim 4-month, the 1st of January to 1st of May, the 8-month 1st of May to 31st of December holding period returns. So table 6, the 1st of January 2014, beginning portfolio value, 100 million. 1st of May 2014, dividend received for additional investments, 2 million. Ending portfolio value is 100 million. So holding period return is 2 plus 10 divided by 100, which is 12%. So new investment is 20 million. Beginning market value for last 2/3 of the year is 132 million. So that's the beginning market value. So at the 31st of December 2014, dividend received was 2.64 million. Ending portfolio value was 140 million. Holding period is 2.64 plus 140 minus 132 divided by 132 is 8.06%. Now we must geometrically link the 4 and 8-month return to compute the annual return. We compute the time-weighted return as follows. The time-weighted return is 1.12 multiplied by 1.0806 subtracted by 1 is 0.2103. In this instance, we compute a time-weighted return of 21.03% for 1 year. The 4-month and 8-month intervals combine to equal 1 year. Taking the square root of the product 1.12 multiplied by 1.0806 will be appropriate only if 1.12 and 1.0806 each applied to 1 full year. So in this case, we don't take the square root because we do not take the 1 full year. We take 4 months, we take 8 months, but we don't take the full year. Solution to 2. So what was 2 asking? 2 was asking compute the Walbrecht Fund's money weighted return. So the first one is time weighted, the second one is money weighted. Okay. To calculate the money weighted return, we find a discount rate that sets the present value of the outflow or the purchases equal to the present value of the inflows or the dividends and future payoffs. The initial market value of the fund and all additions to it are treated as cash flows. Think of them as expenditures. Withdrawals, receipts, and the ending market value of the fund are counted as inflows. The ending market value is the amount investors receive on liquidating the fund. This means selling everything. Because interim cash flows have occurred at 4-month intervals, we must solve for 4-month intervals rate of returns. Table 6 details the cash flow of the timing. The present value equation in millions are as followed. The PV outflows equals the PV inflows. So this right here, the left-hand side of the equation shows the investment in the fund or outflows of 100 million initial investment, followed by the 2 million dividend reinvested and an additional 20 million of new investment, both occurring at the end of the first 4-month interval, which makes the exponent of the denominator 1. The right-hand side of the equation shows the payoff or inflows. The $2 million dividends of the first 4-year interval, followed by the $2.64 million dividend, and the terminal market value of 140 million, both occurring at the end of the third 4th-month interval, which makes the exponent in the denominator 3. The second 4-month interval has no cash flow. We can bring all the terms to the right on the equal sign, arranging them in order of time after the specifications using the spreadsheet of IRR enabled calculator. We use this, which give us 20%. Solution to 3. In this example, the time weighted return of 21.03% is greater than the money weighted return 20%. The Walbrecht Fund's performance was relatively poor during the 8-month period when the fund owned more shares than it was overall. The fact is reflected in a lower money weighted rate of return compared to the time weighted rate of return, as the money weighted rate of return is sensitive to timing and amount of withdrawals in addition to the portfolio. An accurate measurement of portfolio returns is important to the process of evaluating portfolio managers in addition to considering returns. However, analysts must also weigh risks. When we work through example 4, we stop short of suggesting the in-house management was superior to Super Trust because it earned a higher time-weighted rate of return. With risk in focus, we can talk of risk-adjusted performance and made comparisons, only consciously. In other readings, we will discuss the Sharpe ratio, an important risk-adjusted performance measure that we might apply to investment managers' time-weighted rate of return. For now, we have illustrated the major tools of measuring the rate of a portfolio. So that's reading 7, part 3. We'll continue reading 7, part 4 of the CFA Level 1 program curriculum next time.
CFA Level 1, Reading 7, Part 4, Money Market Yields. In our discussion of internal rates of returns and net present value, we refer to the opportunity cost of capital as a market-determined rate. In this section, we begin a discussion of discounted cash flow analysis in actual markets by considering short-term debt markets. To understand the various ways the returns are presented in debt markets, we must discuss some of the conventions for quoting yields on money market instruments. The money market is the market for short-term debt instruments, 1 year maturity or less. Some instruments require the issuer to repay the lender the amount borrowed plus interest. Others are pure discount rates, the lenders and the amount borrowed plus interest rates. Others are pure discount instruments that pays interest as the difference between the amount borrowed and the amount paid back. In the U.S. money market, the classic example is the pure discount instrument is the U.S. Treasury bill, the T-bills. Issued by the Federal Reserve, the face value of the T-bills is the amount the U.S. government promises to pay back to a T-bill investor in buying a T-bill. Investors pay the face value, the face amount less than the discount, and receive the face amount at maturity. The discount is the reduction from the face amount that gives the price for the T-bill. This discount becomes the interest rate that accumulates because the investor receives the face amount at maturity. Thus, investors earn a dollar return equal to the discount if it holds the instrument to maturity. T-bills are by far the most important class of money market instruments in the United States. Other types of money market instruments include commercial paper and bank acceptances, which are discount instruments, and negotiable certificates of deposit, which are interest-bearing instruments. The market for each of these instruments have its own conventions for quoting prices or yields. The remainder of this section examines the quoting conventions for prices and yields. The remainder of this section examines the quoting prices and yields. For T-bills and other money market instruments. In most instances, the quoted yields must be adjusted for the use of other present value problems. Pure discount instruments such as T-bills are quoted differently from U.S. government bonds. T-bills are quoted on bank deposits, bank discount basis rather than on the price basis. The bank discount basis is a quoting convention that annualizes based on a 360-day year. The discount as a percentage of face value. Yields on a bank discount basis is compounded as follows. So RBD is equal to D, 365, FT, multiplied by F and T. RBD is the annualized yield of the bank's discount basis. D is the dollar discounted, which is equal to the difference between the face value of the bill. F is the purchasing price, P0. Purchasing price of P0. F is the face value of the T-bill. T is the actual number of days remaining to maturity. 360 is the bank convention of the number of days in a year. The bank discount yield, often called simply the discount yield, takes the dollar discount from par, for PAR, from par D, and expresses it as a fraction of the face value, not the price of the T-bill. This fraction is then multiplied by the number of periods of lengths T in 1 year. That is 360 divided by T. So T is the actual numbers of days remaining in the maturity, and T is how many days in a year. And 360 is how many days in a year, and T is the actual number of days, where the year is assumed to have 360 days. Annualizing in this fashion assumes simple interest, no compounding. Consider the following examples. Example 6, the bank discount yield. Suppose a T-bill with a face value or par value of 100,000 and 150 days until maturity is selling for $98,000. What is the bank's discount yield? For this example, the dollar discounted D is 2,000, right? Because if we subtract
100,000 by 98,000, we get 2,000. The yield on the bank discount basis is 4.8% as computed with equation 3. So this is how much interest is going to be earned. This is the payment when it is done. How many days are left, and then how many days in a year, which gives us 4.8%. The bank discount formula takes the T-bill's dollar from face value as par, as a fraction of face value, 2%, and then annualizes by the factor 360 divided by 150 equals 2.4. The price of discount instruments such as T-bills is quoted using discount yields, as we typically translate discount yield into price. Suppose we know the bank discount yield of 4.8%, but do not know the price. We solve for the dollar discount D as follows. D equals RBD FT divided by 360, where RBD is 4.8%, the dollar discount. D equals 0.048 multiplied by 100 multiplied by how many days are left. Okay, so 150 divided by 360, which equals 2,000. Once we have computed the dollar discount, the purchase price for the T-bill is its face value minus the dollar discount. F minus D equals 100,000 minus 2,000, which is 98,000. Yield on a bank discount basis is not a meaningful measure of investors' return for 3 reasons. First, the yield is based on the face value of the bond, not on its purchasing price. Returns on investment should be evaluated relatively to the amount of invested. Second, the yield is annualized based on a 360-year rather than a 365-day year. Third, the bank discount yield annualizes with simple interest, which ignores the opportunity to earn interest on interest, aka compound interest. We can extend example 6 to discuss 3 often used alternative yield measures. The first is the holding period return over the remaining life of the instrument, 150 days in the case of the T-bill in example 6. It determines the return that an investor will earn by holding the investment to maturity. As used here, this measure refers to an unannualized rate of return or periodic rate of return. In fixed income markets, this holding period return is called the holding period yield, or HPY. For an instrument that makes one cash payment during its life, HPY is this, where P0 is the initial purchasing price for the instrument, P1 is the price received for the instrument at its maturity, and D1 is the cash distributed paid by the instrument at its maturity, i.e. it's the interest. When we use this expression to calculate the holding period yield for an interest-bearing instrument, for example, coupon-bearing bonds, we need to observe an important detail. The purchase and sale price must include any accrued interests added to the trade price, because the bond was traded between interest payment dates. Accrued interest is the coupon interest that the seller earns from the last coupon date, but does not receive as a coupon because the next coupon date occurs after the date of sale. For pure discount securities, all of the returns is derived by redeeming the bill for more than its purchase price, because the T-bill is a pure discount instrument. It makes no interest payments, and thus D1 equals 0. Therefore, the holding period yield is the dollar discount dividend divided by the purchase price. The HPY is equal to D divided by P0, where D equals P1 minus P0. The holding period yield is the amount that is annualized in the other measure. For the T-bill in example 6, the investment of 96,000 will pay 100,000 in 150 days. The holding period yield on the investment using equation 4 is 100,000 minus 98 divided by 98 equals 2,000 divided by 98,000 equals 2.0408%. For this example, the period return of 2.0408% is associated with the 150-day period, If we were to use the T-bill rate of return as the opportunity cost of investing, we will use the discount rate of 2.0408% for the 450-day for the percent as for the T-bill to find the present value of any other cash flow to be received in 150 days. As long as the other cash flow has risk characteristics similar to those of the T-bill, this approach is appropriate. If the other cash flows were riskier than the T-bill, we could use the T-bill's yields as a base rate to which we could add a risk premium. The formula for the holding period yield is the same regardless of the currency of denomination. The second measure of the yield is the effective annual yield, or the EAY. The EAY takes the quantity 1 plus the holding period yield and compounds it further to 1 year, then subtracts 1 to recover an annualized return that accounts for the effect of interest on interest. EAY equals 1 plus HPY to the power of 365 divided by T subtracted by 1. In our example, we could solve for EAY as follows. EAY is equal to 1.020408 to the power of 365 divided by 150 subtracted by 1, which equals 5.0388%. This example illustrates a general rule. The bank discount yield is less than the effective annual yield. The third alternative measure of yield is the money market yield, also known as the CD equivalent yield. This convention makes the quoted yield on a T-bill comparable to the yield quotations on interest-bearing money market instruments that pays interest on 360-day basis. In general, the money market yield is equal to the annualized holding period yield, assuming a 360-day year. RMM is equal to HPY multiplied by 360 divided by T. Compared to the bank discount yield, the money market yield is computed on the purchase price, so RMM is equal to RBD multiplied by F divided by P0. This equation shows that the money market yield is larger than the bank discount yield in practice. The following expression is more useful because it does not require knowing the T-bill price. So RRM is equal to 360. So we don't have to know the T-bill price in order to calculate this percentage using the money market yield. So the T-bill example, the money market yield is RMM is equal to 360 multiplied by 0.048 divided by 360 minus 150 multiplied by 0.048, which gives us the interest rate of 4.898%. Okay, table 7. 3 commonly used yield measures. We have the holding period yield, we have the effective annual yield, and we have the money market yield. So the holding period yield, the HPY, is this. The effective annual yield is this. And the money market yield is this. So interesting to take note that 1 year for each of these examples is 360 days. What? The effective annual yield is 365. Okay, this is just confusing. The next example will help you consolidate your knowledge of those yield measures. Example 7, using the appropriate discount rate. You need to find the present value of a cash flow of $1,000 is to be received in 150 days. You decide to look at a T-bill maturing in 150 days to determine the relevant interest rate for calculating the present value. You find a variety of yields for the 150-day bill. Table 8 presents this information. So short-term money market yields, if we use the holding period yield, we have a 2.0208%. Bank discount yield, we have a 4.8%. Money market yield, we have a 4.898%. Effective annual yield, we have a 5.0388%. Which yield or yields are appropriate for finding the present value of the $1,000 to be received in 150 days? Solution: the holding period yield is appropriate, and we could use the the money market yield and effective annual yield after converting them to a holding period yield. Holding period yield of 2.0408%. This yield is exactly what we want because it applies to 150-day periods. We could use it straightforward fashion to find the present value of the $1,000 to be received in 150 days. Recall the principle that discount rates must be compatible with the time period. The present value is PV equals $1,000 divided by 1.020408, which is the what is that? Where does 1.1402 come from? Oh, right, because there's only 150 days left. So therefore, instead of being the full 2.0408%, we have the 1.020408%. Okay, that kind of makes sense. Equals to $980. So now we could see why the other yield measures are inappropriate or not so easily applied. Bank discount yields of 4.8%. We should not use this yield to measure to determine the present value of the cash flows. As mentioned earlier, the bank discount yield is based on the face value of the bill and not on its price. Money market yield of 4.898%. To use the money market yield, we need to convert it to the 150-day holding period yield by dividing it by 365 divided by 150, by obtaining the holding period yield of 0.04898 divided by 360 divided by 150. It gives us 0.020408. 0408 is my birthday, so it's weird for me to say that. We use it to discount the $1,000 as above. Effective annual yield is 5.00388%. This yield has also been annualized, so it must be adjusted to be compatible with the timing of the cash flow. We can obtain the holding period yield from the EAY as follows: 1.050388 to the power of 115 divided by 365 subtracted by 1 gives us 0.020408. Recall that when we find the effective annual yield, the exponent was 365 divided by 150, or the number of the 150-day period in a 365-day year. To shrink the effective annual yield of a 150-day yield, we use the reciprocal of the exponent that we use to annualize. In example 7, we converted two short-term measures of annual yields to a holding period yield. As an example, many bonds, long-term debt instruments pay interest semi-annually. Bond investors compare IRR for bonds known as yield to maturity, or the YTM. If the semi-annual yield to maturity is 4%, how do we annualize it? An exact approach taking account of compounding would be to compute 1.04 to the power of 2 subtracted by 1, which equals 0.08016, or 8.16%. This is what we have been calling the effective annual yield and approach to the U.S. bond market. However, is to double the semi-annual YTM gives us 4%, multiplied by 2 is 8%. The yield to maturity calculated this year, ignoring compounding, has been called bond equivalent yield. Annualizing a semi-annual yield by doubling its putting the yield on a bond equivalent basis is practice. In practice, the results 8% would be referred to as simply the bond yield to maturity in money markets. If we annualize a 6-month period yield by doubling it in order to make the results comparable to bonds YTMs, we would also say that the results was a bond equivalent yield. So, what is the summary? Now, we've done a lot of reading. What is the summary? In this reading, we applied the concepts of present value, net present value, and internal rates of return to the fundamental problem of value investments. We applied these concepts first to corporate investments, the well-known capital budgeting problem. We then examined the fundamental problem of calculating the return of a portfolio subject to cash inflows and outflows. Finally, we discussed money market yields and basic bond market terminology. The following summarizes the reading's key concepts. Now let's read that again. I'm going to read the summary twice. So I'm going to read the whole summary, which is almost a page, a little bit more than a page. I'm going to read it twice because it is such important. I may have been able to gone through most of the content on the top just reading it once, but I think the summary is important, so I'm going to read it twice. So I'm going to read it once now. The net present value, or the NPV, of a project is the present value of its cash inflows minus the present value of the cash outflows. The internal rate of return, the IRR, is the discount rate that makes NPV equal to 0. We can interpret IRR as expected compound return only when interim cash flows have been reinvested at the internal rate of return and the investment is maintained to maturity. The NPV rule for decision making is to accept all projects with positive NPV, or if projects are maturely exclusive. To accept the project with the higher positive NPV, with maturity exclusive projects, we rely on the NPV value. The IRR rule is to accept all projects with an internal rate of return exceeding the required rate of return. The IRR rule can be affected by problems of scale and timing of cash flows. Money-weighted rate of return and time-weighted rate of return are two alternative methods for calculating portfolio returns in a multi-period setting. When the portfolio is subject to additions and withdrawals, time-weighted rate of returns is the standard in the investment management industry. Money-weighted returns can be appropriate for investors exercise control over additions and withdrawals to the portfolio. Money weighted return is the internal rate of return on a portfolio taking account of all cash flows. Time weighted rate of return removes all effects of time and amounts of withdrawals and additions to the portfolios and reflects the compound rate of growth of 1 unit of currency invested over a stated measurement period. The bank yield for U.S. Treasury bills and other money market instruments sold on discount basis is given by RBD equals F minus PO divided by F multiplied by 360 divided by T equals D divided by F multiplied by 360 divided by T, where F is the face value amounts of to be received at maturity. P0 is the price of the Treasury bill. T is the number of days to maturity, and D is the dollars discounted. For a stated holding period or horizon, holding period yields, or HPY, equals ending price subtracted by the beginning price plus cash distributions divided by beginning price. For a U.S. Treasury bill, HPY is equal to D divided by P0. The effective annual yield of EAY is 1 plus HPY to the power of 365 divided by T subtracted by 1. The money market yield is given by RMM equals HPY multiplied by 360 divided by T, where T is the numbers of days to maturity. For a Treasury bill, money market yields can be obtained from the bank discount yield using RMM equals 360 multiplied by RBD divided by 360 subtracted by T minus RBD. We can convert back and forth between holding period yields, money market yields, and effective annual yields by using the holding period yield, which is common to all of the calculations. The bond equivalent yield of a yield stated on a semi-annual basis is the yield multiplied by 2. Here are the references, here are the practice problems. I won't read the practice problems, but I will read the summary again. So here's the summary again. In this reading, we applied the concepts of present value,
net present value and internal rate of returns to the fundamental problem of valuing investments. We applied these concepts first to corporate investments, the well-known capital budgeting problem. We then examined the fundamental problem of calculating the returns on a portfolio subject to cash inflows and outflows. Finally, we discuss money market yields and basic bond market terminology. The following summarizes the reading's key concepts. The net present value, or the NPV, of a project is the present value of its cash inflows minus the present value of its cash outflows. The internal rate of return, or the IRR, the net present value of a project is the present value of the cash inflows minus the present value of the cash outflows. The internal rate of return, or the IRR, is the discounted rate that makes NPV equal to 0. We can interpret IRR as an expected compound return only when all interim cash flows can be reinvested at the internal rate of return and the investment is maintained to maturity. The NPV rule for discount decision making is to accept all projections with positive NPV or if projects are mutually exclusive. To accept the projects with the higher positive NPV with mutually exclusive projects, we rely on the NPV value rule. The IRR rule is to accept all projects with an internal rate of return exceeding the required rate of return. The IRR rule can be affected by problems of scale and timing of cash flows. Money weighing rate of returns and time weighing rate of returns are two alternative methods for calculating portfolio returns in multi-period settings when the portfolio is subject to additions and withdrawals. Time-weighted rate of returns is the standard in the investment management industry. Money-weighted rate of returns can be appropriate if the investor exercises control over additions and withdrawals to the portfolio. Money-weighted weighing rate of returns is the internal rate of returns on a portfolio taking account of all cash flows. The time-weighted rate of return removes the effect of time and amount of withdrawals and addition to the portfolios to reflect the compound rate of growth of 1 unit of currency invested over a stated measurement period. The bank discount yield for U.S. Treasury bills and other money market instruments sold at a discounted basis is given by RBD is equal to F minus P0 divided by F multiplied by 360 divided by T is equal to D divided by F multiplied by 360 divided by T, or F is the face amount to be received at maturity, P0 is the price of the treasury bill, T is the number of days to maturity, and D is the dollar discounted. For a stated holding period or horizon, holding period yield HPY equals ending price subtract the beginning price plus the cash distribution divided by the beginning price. For a U.S. Treasury bill, HPY is equal to D divided by P0. The effective annual yield is equal to of EAY. The effective annual yield is 1 plus HPY to the power of 365 divided by T subtracted by 1. The money market yield is given by RMM is equal to HPY multiplied by 360 divided by T, where T is the number of days to maturity. For a treasury bill, money market yields can be obtained from the bank discount yield using RMM equals 360 multiplied by RBD divided by 360 subtract by T multiplied by RBD. We could convert back and forth between holding period yields, money market yields, and effective annual yields by using the holding period yield, which is common to all the calculations. The bond equivalent yield of a yield stated of a semi-annual basis that yields multiples of 2. So here are the references, here's the practice problems. I'll do separate videos for practice problems and solutions. So next, we have statistical concepts and market returns. So that's reading 8. We're going to continue reading 8 in our next video. So I do hope my readings have been helpful. And I hope going through the content with you has been helpful. And I hope to see you guys in the next video. Goodbye.